Welcome back, my financially intentional people. I am juiced to have my good homie, Acquania Escarne, joining us again as our life insurance expert. And today we're just going to dive right into how she became a Black woman hotel owner and how she was able to use her life insurance to facilitate that. So, hey, Acquania, because I know people are going to be like, what? But anyway, I'll let you just share your story because I know you're just good at it. So let's go.
All right. So I actually started my journey into expanding my real estate portfolio with life insurance in 2016. But I have to start at the beginning where before my husband and I got married, we met with a financial advisor and we got our finances on the same page. And so a part of that discussion was life insurance. We knew that we were committed to be with each other. And she explained to us the importance of getting life insurance while we were young and healthy. And so we decided in our late 20s to get life insurance. And at that time, with no kids and bills that we can manage and extra cash flow, we opted to get permanent life insurance, which is the type of life insurance that doesn't expire, but it also allows you to build what we call cash value. So I want to be clear that we met with the professional, we reviewed our finances, and we had the cash flow to do this. For most people, term life insurance, the type of coverage that expires, that also gives you a lot of coverage for less money, is the best solution. But if you meet with someone and determine that you can afford permanent insurance, it's a great way to get covered. Make sure that you have insurance that doesn't expire.
You are that person that people can meet with.
Yes, I am that person. So you can call me, you can talk to me, but just know, okay, just know permanent insurance always costs more than term because it's guaranteed to be paid out. And the insurance companies are going to charge a little bit more for that 100% payout that you're going to get. But it's a great option for those who can afford it. And it's also a great strategy you can leverage later. So my husband and I started with those policies in our late 20s and we let them grow for a few years, rented out our condo while we lived abroad for 3 years, and came back with enough money to really buckle down into real estate. So we used $40,000 from a life insurance policy to purchase property in 2016, in addition to helping my mother-in-law get a condo. And then we also purchased our dream home. So we used that life insurance money to leverage 3 properties in addition to some of our savings. And I want to emphasize this because unlike money from stocks and other investments you have, where if you cash out some of that money by selling, you may incur some taxes, right, on that capital gains. We actually were able to take from a life insurance policy. And when you take money from life insurance, it's tax free and it's also yours, right, to leverage. So we were able to use tax-free dollars to get into real estate investing, which is super important. So that's how we bought 3 properties in 1 year. And it really helped us expand not only our ability to create passive income, but it also expanded our opportunities, right? Because this is a space that most people aren't doing. They're not leveraging life insurance to invest in real estate. They don't realize this is tax-free dollars.
But let me just emphasize, let me just clarify, I should say. Mm-hmm. So when you're saying you're leveraging that money, so you're taking that money out, are you borrowing that money, meaning that you have to pay back that money? Or is it just like, it's just your money and you're just spending it?
Mm-hmm. That's a great question. So you have 2 choices. You can withdraw it permanently, which means you will not be able to return it. And in those cases, any gains are taxable, but any of the premiums you paid are not. So most of the time, you'll only pay a small portion of taxes on the gains. However, you can also borrow, right? So borrowing is when it's completely tax-free. And it doesn't have to be paid back, but you can choose to pay it back. And if you do, then you can just use that bank again, right? So some people will call it infinite banking, or a strategy where you become your own bank, where you can take money out, you can put it back at any type of pay scale you want to, whether it's monthly or never again. People think that's crazy. They're like, how do you not pay it ever again? And I said, well, that's how it works. But there is a catch. When you borrow money and you choose not to pay it back, they do end up taking it out of the death benefit. So if you have $100,000 death benefit and you took out $20,000, when you pass away, your family gets $80,000 instead of $100,000. So they do get that money back in some way. But a lot of times I tell people this is a strategy that allows you to use your life insurance money while you're alive. And after you're dead, as long as you still left enough money for expenses and for your family, then they're still good, right? 80,000 is still better than zero. And it allows you to leverage 20,000 while you're alive. So this is how rich people normally leverage tax-free dollars in retirement or while they're alive. And what I like about this strategy is it has nothing to do with your income. You know, a lot of people, I love Roth individual retirement accounts because that's how I started to save for retirement. But honestly, a Roth has income limitations. You know, once you make too much money as a single person or a married couple, you are no longer eligible to contribute to Roth IRAs unless you do the backdoor strategy, right? So a lot of times you find yourself in that high six-figure income and not that many tax-free buckets. So life insurance can be another tax-free bucket for you. And so that's another thing to think about. And me personally, I love tax-free buckets. I want to have as many as possible. And you can have more than one life insurance policy. So I've chosen to leverage life insurance and Roth IRAs because I still have the one that I have from 16 as my means to increase my tax-free bucket. So that's another thing to think about.
Yes. I love that. And a lot of people don't know that you can actually take contributions early from your Roth IRA up to how much you contributed or up to the gains if they've been invested for 5 years. And that's a way that people in early retirement usually can tap into retirement funds before. So just a little nugget there. Yes.
Yes, I love that. And you are allowed by the IRS to take from a Roth IRA if you need to in the event of hardship, emergency, or to fund your education or to buy real estate. So your Roth IRA can also be where you get a down payment for a home, depending on how long the money's been in the account and the reason that you're taking it out early. But that's a completely justifiable expense. And if you check out irs.gov, you'll see a list of other eligible reasons to take from a Roth before you're 59 and a half. And those are all exceptions that you can use for yourself. And I would say don't be afraid of an audit because, of course, in that year, I do all these things in 2016 and we did have an IRS audit, but it was really simple. They sent us a letter. They said, hey, we noticed you took money out of these different accounts. I did also take money out of a Roth IRA that year, not too much, but some. And all I had to do was show them that I had that account from 16 and here's the proof of the transactions that we used to put money in it. And here's the proof that when we took it out, that was purely contributions and gains that had been there for 5 years. And the IRS was very satisfied with the documentation. So this is really important for you to remember, like whatever you do, just have documentation, keep good records on all of your investments. That's really important anyway. And just be prepared that if the IRS asks questions, that you provide the documentation that justifies the actions you took. And then it just goes away.
They just need to see a paper trail. A lot of times people are so afraid, but they just need to see that there's some kind of paper trail there because they can't access it, but we can access it. You just go online, you go to call Vanguard, call Fidelity, say, hey, I need this paperwork, and then send it and it's done. Yeah.
Absolutely. And that's all I had to do. And I would say, even if you decide to move your money, so the Roth IRA or the company I had my Roth with at 16 is not the company I have it with now, but I have all the records of the rollovers and, the different changes I did to go to an account that made sense for me. So it's okay to move your money. It's okay to use your money, but definitely keep good. But that's how I started leveraging life insurance to invest in real estate. And then later I decided I didn't like toilets and tenants. So you want to talk about that now? So truth be told, one of the properties we purchased was a rental property in Philadelphia, West Philadelphia to be exact. And I realized that I did not like toilets and tenants after facing one eviction and successfully getting that person out of the house who was not paying rent after a few months. We put in another tenant and then noticed a pattern that, hey, Christmas is coming. rent is short. What are we going to do? And I really knew in my heart of hearts that I did not get into real estate investing to evict people. And I knew that that was something that, you know, to be a landlord, that's something you have to be prepared to do. And so my dad told me, he said, look, if you can't kick out your mom from your own property, then you don't have the skin to be a landlord, and you should reconsider.
That's a word.
And so I started asking, that's right. My dad he's super like strict too. He's in military, and he's just like, it's black or white for me, boo. Like, kick her out or lose money. Right. So in when did we sell that house? I think it was 2020. Oh no, 2019. Yeah, 2019, we sold that rental to another investor, made a really decent cut even. But then I had this income, or cash, that I needed to reinvest. And I was praying on, you know, how do I stay into real estate investing with dealing with toilets and tenants? Because you know, some people would have been discouraged. Some people would have been like, real estate's not for me. I got burned. I'm giving up. And I was like, no, I don't want to give up, because I know that real estate is a great way to make money, but I just need to find the way that makes sense for me. So I really asked around my network, well, how can I get into real estate and not have to deal with people, not have to deal with maintenance? And interestingly enough, a coworker of mine told me about apartment syndication. And she was just like, you know, I do these apartment syndication deals outside of work. That's my side hustle. And I was like, what is that? So apartment syndications are basically investors who buy apartment developments, you know, with 100 units or 200, 300. They're the big subdivisions where you might have lived in the past in an apartment. And the manager manages the tenants and the toilets and the leases, but the investors benefit from the profits and the proceeds. So she gave me some insight into how you can be one of those investors. Most of the time, you have to know someone who does it. You also may need to be an accredited investor to invest, or know someone who is accredited and you are what they would call a friend or a non-accredited investor who can still invest in a deal because you have some type of connection, right? So I learned about apartment syndications, and I was like, oh, I want to get into that. And then guess what happened? 2020, there's the government did allow like an exception in that year for people to borrow from their retirement assets if they wanted to, and have a longer term to pay it back, or to be able to take money to survive. There were no deals, right? So I had money from the house that I sold in Philly. I had the ability to access retirement funds from my job if I wanted to, but I had no deal, right? And I don't recommend you take money out of anything that's generating income, even if it's passive and interest, if you don't have a deal. So I kind of waited until I found something. And my friends who do apartment syndications never found a good deal in 2020, but they introduced me to someone else who does hotels. So Instagram is an amazing space where your Instagram besties will introduce you to other Instagram besties. And in this case, a friend introduced me to Davon Reeves and Jessica Myers, who have a company called Epic Collective. They help people invest together in hotels. And I initially was like just amazed by the topic and the concept that I had them on my podcast, the Purpose of Money podcast. And we recorded episode 26 where we talk about investing in hotels. But honestly, I was like you, Nasima. I was just like, this is a really interesting topic. I'm going to talk about it on my show, but I don't know if this is for me, right? So hold on a second. So I decided like, hey, like, let me make friends, right? Not just have them on my show, but let's make friends and see if when we foster this relationship, something else comes out of it. So believe it or not, I signed up for their email list. I got on their email, and they sent an email like a month after we recorded about a Hilton Home 2 Suites opportunity. And I was like, oh my God, like they don't just say they get people in the hotels, right? Like they do it. And here's the deal, right? So I saw the opportunity in the email, asked for the proposal and the prospectus, and then went for it. Like I would say September, I told them I was interested. October, I sent the money. And at the end of October, we closed, and like the rest is history. But That is my long story short on how I went from rentals to hotels. And now I do have apartment syndications, but it took another year, 2021, before I could find a good apartment syndication deal. And I love them both.
But this is all like started from, well, did you get out of like just rental, like buy and hold rentals altogether? Okay.
Most part, I still have one and it's still rented, and mostly because the tenant's a good tenant. They love the house, and you know, why mess up a good thing? But everything else we got rid of because I didn't have the patience. I didn't want to deal with it. And I learned in my process of getting into hotel ownership and into apartment syndications that the amount of money that I spent to buy a rental, I could have had ownership in a hotel. And so that's was the aha moment for me, right? Because I was like, wait, the down payment, because I live in an expensive area. Washington, D.C. is expensive. And most people, rental properties are an investment, and the bank will consider, you know, the need for a larger down payment. So sometimes they want 20%, unless it's multifamily and you're living in one of the units and you can get a FHA loan, right? And then maybe you'll do 3 to 5%. But for me, who had a house with my family and didn't plan to move into anything just to be able to rent it, I needed to think about the cost of 20% down versus that money into something else. And they were coming out to be the same, if not less, right? Because sometimes you can partner with other people on these joint ventures that you can't necessarily part in the same way if you're doing it for real estate. So that's what happened. And so I'm going to go ahead and put this out there because I know people ask all the time, how much does it cost to get into hotel ownership? How much does it cost to get into apartment syndications? And I will say it depends. They are independent deals, and how much money needs to be raised depends on how much money they need for closing. So in the hotel that I did, for example, you know, we were taking over the mortgage from the previous owner. So that's a much lower fee. You just have to come up with enough money to take over the payments and some money to kind of reserves for the property. So in 2020, you could find a good deal where 25,000 would be the minimum to get into some hotels. Whereas after 2020, when the market was, y'all know, at its height, real estate was really competitive. People were like struggling to find houses. You found yourself seeing the minimums increase. So for apartment syndications, for example, by 2021, they went from 25,000 minimums to 50,000. And there are some out there that the minimum's 100,000 or $1 million. So it really depends on the deal. What I would say is just continue to be on the email list of those who advertise these deals, because I do that on my list, for example, and you'll never see them on social media. Let me say this again. You will never see them on social media. And the reason I say that is because there's a lot of rules. There's a lot of SEC rules about who can know about the opportunities and who can put money into them. So we can't advertise deals like this on social, but we can advertise them to people we know, quote unquote, on our email list, or to our friends and family who may know people who are eligible investors. And then from there, you can respond to the email, you can listen to the webinar, you can ask questions, and then you can decide if that investment is right for you. So I want you to know, like, the best place to start in some cases is to follow other people who do what you're trying to do, like hotel investing or apartment syndication investing, and then get on their email list, get to know them, because you'll be investing with them, right? So you want to know who you're giving your money to and who you're in bed with, per se. So that's how I got started, and that's about how much it could cost. But like I said, if your deal requires more capital, like say, if I was doing a hotel that we're going to build, that's a much, much higher investment than one that's already existing. So building a hotel might have a much higher buy-in, right? But as an investor, you do get equity. Occasionally, depending on the deal, you will also get hotel benefits like free stays at your own hotel, discounted stays at the chain if you invest in a chain. And then you also get access to profits, right? So every deal is different, but sometimes you will get quarterly dividends based on the performance of the business. Because remember, a hotel, you're not just buying land, you're buying and operating that sells rooms, that sells food at the market, breakfast, may have a restaurant, may sell internet. These are all income streams that eventually will go back into the business and to the investors. Or some deals you will get quarterly, monthly distributions. Like for my apartment syndication, for example, we get monthly distributions based on the rent collected. So you have people who live there, as long as they pay their rent, then you get a portion of the rent too. And that could be paid out as often as monthly.
This is all good stuff, but I kind of want to go back to the fact that, you just like, first of all, a lot of my current friends that I have are people that I aspire to, are people that, I want to be on the same page of financially. And the way that I made those relationships was, first just finding them, staying in contact with them. And then before you know it, we're friends in real life, right? So it's just like who my network is, right? My net worth. And they say, of course, your network is your net worth, right? And so people are like, well, how do you get in the rooms with these people? I just make these people my friends. And that's what you did. You had this person on your podcast and you was like, this is like a very interesting person. I'm going to go ahead and follow her. It's not like you stalked her. You were on her email list. You started to engage and you just became visible in the community. And once you become visible in the community, then people are like, oh, okay. Like then you start building those relationships that, these people actually are friends in real life. And that opened up a whole new world to you because initially the apartment syndications didn't work out. But they were just like, but we got this situation going on. And I actually remember listening to that episode that came out with the hotels. And I was like so intrigued. And then talk to you about it. And you were just like, yeah, it's really not that hard, but it did seem intimidating. But if I hadn't dived a little further, I would have thought that it was like way outside of my reach. I mean, like who talks about owning hotels? Like nobody owns hotels. Exactly. But the thing is, like you said, you put it in perspective, like it's the same as you would put down on any kind of rental property, except now you got all these doors and you have all these other revenue streams because of the business model of a hotel. So I really love that. I also love the syndication deals because you're opened up to, bigger properties. You're not dealing with the day-to-day management. And it's just like you're investing. And like I said, the investment, like you said, the investments can be just as small as just you buying one individual property. However, you're reaping these quarterly or monthly rewards where it's almost like passive income, but you're still in real estate, but you're not an active landlord. So I just wanted to recap that for people that might not have caught it because it was just like so many gems in there. But it all came back to you having access to resources and not a lot of resources. And the thing is, most people have access to these resources. They just don't know how to tap into it. So I just want to ask, like, from a life insurance perspective, like, do you continuously buy life insurance policies, or do you just have like these life insurance policies that you've had for years that you can access because you done the infinite banking where you access the resources, you paid it back? Like how much in life insurance policies do you actively hold?
Both. So I'm a huge fan that you need a combo strategy. So don't get it twisted. I do have a term policy. That's my big mamma jamma, right? Like that's the highest one. That's no cost for me because I also got that while I was young and healthy, but it's going to give my family, the figures they need to finish paying off the real estate we have, kids in college if I pass away too soon, and other things, right? But I've used the cash value policies as a means to have this bank created, got in at 25, so able to do it at a cheaper cost and leverage it. But what I've been doing is using, making sure you have what you need. So my family knows if something happens tomorrow, they're set. They're taken care of. Houses can be paid off. college can be paid for, and what I currently contribute to the household can be covered for 10 years, right? Because at the end of the day, that is number one priority. And for some people, you're going to make that solution through term insurance. But in my case, I was able to afford both term and permanent in order to make ends meet if I die too soon. But I actually have a plan. I want to get another policy before my 40th birthday. It's nothing necessary about 40 because that's not actually a year policies jump in cost, but it's a milestone for me that, hey, I want to get another policy before 40. And this is something that I want to do to build another bank, another access for myself. And it'll be used to fund even more additional tax-free dollars in the future. But you can do one policy and, like I said, keep taking the money from it, putting it back, taking the money from it, putting it back, or you can do multiple policies, right? I'm a fan of get as much insurance you need as often as you need it. And there's a strategy in the life insurance space. It's called the stack policy structure, where if you choose to do a lot of term policies, you will get new ones as your existing terms are about to expire. So that way you never run out of insurance. When one policy expires, you already have the other one in place and you're stacking them in that way while you're still insurable. Other thing you can do that I recommend is getting getting term policies that are able to convert to permanent insurance. And the reason I say that is because term is cheap, right? But when you lock in your term, you're also locking in your health classification. So even if your health gets worse, you're still able to get permanent insurance later. And when you convert it, the companies don't ask about your health. They only take in consideration your age, and they will quote you a price based on your age. And so that's another way to protect your insurability. It's like getting a whole bunch of term that can convert to permanent when you're ready. And then you can stack your term policies. So let's say you have a 10-year policy, for example, and you get another one at 8 years right before your term's about to expire. And you can get a permanent policy at the same time if you can afford it. And that way you'll have one policy that will expire and one that will never expire. So for example, another strategy I may use is if I meet with you and we're like, look, at 60, your house is going to be paid off, but then your kids will be grown. And maybe at that point you want to leave money to your grandkids. Let's get a term policy that'll cover your mortgage, college, and your salary until 60. But then at 60, let's drop the $1 million policy and let's just keep the permanent one, which let's say we get them at the same time and it's $250,000, right? So when you were 30 and you got $1 million term and a $250,000 permanent policy, you had $1.2 million in coverage, right? But by 60, that term drops off, that money returns to your budget, but that $250,000 one, not only is it still there, you got it at 30 when it was super cheap, and now it could be fully paid because there is a strategy where when you make your payments spread out while you're working, you don't have to make payments when you're not. So a lot of my clients, I will stop their payments into life insurance when they hit retirement, and we will let that money continue to grow. They can use some of it in retirement if they want to, and then they still have this death benefit that goes to their family when they die. But the other cool thing is some companies, once you've made so many payments, they start to give you more of that money back in the death benefit. So you might sign up for a $250K policy at 30, but by the time you're 70, that could be a $300,000, $400,000 policy because now you're getting money back in the death benefit, in addition to the cash you've built up, in addition to the interest you've earned. So there's so many benefits to permanent insurance that everyone doesn't, but they don't do that for term. Your term policy is not going to get extra money added to it. You're literally just paying for whatever you signed up for. But when you have permanent insurance and you've made payments for 20 years, you start to get some of that money back in cash value and in a higher death benefit. So you leave your family more money than you even thought. So
yeah, and I think another thing to consider is that you can actually convert like part of your term. Like you don't have to convert your whole term policy over. You can convert part of your term over to a whole life policy. I know I get the notification like once a year, like, hey, you have this benefit, you can convert that. So that's also a strategy as well, right? So how does that work?
Yep. So a lot of times it depends on your company, it depends on the contract, but a lot of times you do just fill out a piece of paper or make a phone call and say, I'd like to convert. And they, like I said, they don't ask you medical questions because that's one of the deals you made is I won't have to do medical, but you will allow me to get this policy. Some companies will let you get up to the amount of insurance you have in term. Some companies, like you said, will let you break off a piece and have the policy and so that's permanent and keep the term. But it really just depends on the company and how they do it. But that's a great strategy. And that's why I start people with term that they can convert so they have options. I think that's the key is to have options. And then when you can afford the permanent policy,
and that's the thing, it's like if you lock in a term policy really early, it's very favorable for you to do all of these things. And I think a lot of people just want to wait. And I would say like term, for example, I got my term policy when I was 36. So that's still really, really late, right? That's like years and years after you got yours, right? 11 years after you got your policy. But for a $2 million policy, I was paying $700 a year at 36. So it's just like, it's still very affordable. But had I locked that in when I was older, when I was younger, it would have been even cheaper than that. And that's hella cheap. $700 for $2 million.
Yes.
That's hella cheap, right? But what that allows me to do, like Acquania says, like if I can take a portion of that, like I have since broken off 500,000 of that and put it in a term to 80 policy, which is a little bit different. We haven't talked about, but which is like guaranteeing it up to, my policy up to the time I'm 80 years old, which is almost a whole life policy, but cheaper because it's still a term policy. And but then I've also been able to add on to my policy, like a whole life policy. And then I can still add on to that because I have these benefits because I locked in that rate at 36. And so I like that stacking methodology. And I actually think I'm going to look at kind of rolling off even more of my benefit into a whole life, into a permanent policy. And like you said, there are so many benefits to permanent policies. But what I always am like caution people about is that there are so many benefits, but then there are so many people in the insurance space that try to sell you into products that you don't necessarily need at that time. That is super duper important that the person that you're dealing with and that they are credible. So that's why I have Acquania here, because there are so many people that are like MLM and, like they're selling products that you probably don't need, right? Yeah.
So I'm no shade. I'm an independent life insurance agent, and everyone out there, do your thing. But independent means I'm not tied to one company. I can shop around. I can look at the products and the companies that are best for you. But there are other people out there that they work for a specific company. They don't have flexibility. They can't necessarily compare and shop products. And they may work with a multi-level marketing company that sells life insurance. Now, I want to be clear, what they're selling you is life insurance. No one can legally sell you anything else other than life insurance if that's what they sell, right? We get licenses, we take tests, we are authorized to sell it, but everyone is different. All the products are different. So really make sure you read the fine print, understand what you can and cannot do with that policy, and make sure it meets your needs, which is covers your family and provides for them when it's most important, right? But just know that it has to be a good fit for you. You have to trust that person, because life insurance is not a one and done thing. This is someone who you should be connecting with on an annual basis to make sure that you have enough insurance, or if you get a divorce, that you take off the beneficiaries that no longer should have access to this money. And if you need to increase your insurance because you're bringing life into this world, those are all the things you want to do on a regular basis with your agent. And so I tell people it's a lifetime commitment, because God willing, I will know you as long as you know me, because this policy will cover you for the rest of your life, or for the next 30 years of your life, or until you're 80 years old, like you said, with your term 80 policy. So try to look for someone who you feel like that's the relationship you're going to build, and you have the ability to do that together. But there are people who, they work with companies, and that might be the first access point they have to get into this space. So I'm not throwing shade at anyone who's with MLM or other companies that are not as flexible, but you can ask those questions. You can ask an agent, are you a captive agent? Do you have the ability to shop rates? Do you have more than one company that you are looking at for me? And then ask them why. You can also ask, what is your commission? Is it based on what you sell me or how much you sell me, or is it the same? I'm always fully transparent. My commission is the same with every single company I work with. So I don't have an incentive to do business with one company over the other. My incentive is to provide you what's best for you. But there may be agents out there who get a different commission based on the product, right? And they may push one product over another one because of that. But those are questions that you have full right to ask.
I love that. So let's just summarize here. Like, if somebody really wanted to get into syndication or owning a hotel, what are the steps that they can take? And say they have access to a permanent policy, which they can tap into. Like, can you summarize like what those steps would be? Yeah.
How to do it? Yeah, absolutely. And so I also want you guys to know, like, if you don't have a permanent policy,
Right.
Don't feel like you can't invest. They'll take your cash too. And I also, as an entrepreneur, I do have a solo 401k, which is a retirement account for entrepreneurs or those who have businesses and self-employed. And I leverage that to do real estate deals too. So I pay myself for retirement, right? But then I take that money and invest in real estate.
Oh, but I should also mention too, you can have a self-funded IRA as well. If you can have a self-directed IRA. Someone, instead of just putting it into a traditional or a Roth IRA, you can have a self-directed IRA, which you can use to invest too. So just put that out there. Yes.
Yes, absolutely. Yes. And mind you, the solo 401k I have, I was a 9-to-5 employee forever and still had this account too, but I have access because I also have a business, right? So find your money, whether it's life insurance, solo 401ks, self-directed IRAs, or your cash. Find your money and then find your deals. So follow people on social media like myself. Davon Reeves is at Davon, DAVONNE Reeves, REAVES. She's the hotel diva. We are investing besties, and she's one person I trust in a space, and she's done it for 15 plus. You also have the hip hop hotel broker. Omari is in this space, really popular, and he helps leverage deals all the time. But those are the Black people in the space that I truly trust. And I think that you need to find people who are already doing it. Get yourself on their email list so you can see the deals as they come through and you can see what makes sense to you. But they should be, if they're not immediately accessible, they should have a team that is, or someone that you can talk to when you are ready to proceed. And definitely look at the documents, like look at the prospectus, look at the proposal, the timeline, the plan. A lot of times you're going to be purchasing apartments and hotels that need work or need new management or need some type of fixing before they are as profitable as they could be. And that's where the return comes in for the investors. So make sure the plan makes sense and make sure the people who are pushing this plan have the experience to execute it and the ability to follow through. And last but not least, if you do invest, make sure this is money you can afford to invest. So I didn't mention this, but most deals, you're going to be tying up your investment for 3 to 5 years, sometimes as long as 7. And although you will get that cash flow throughout ownership, the biggest return comes at the point of sale, because that's when you're going to get that payout of 2 to 3 times your initial investment, in addition to whatever you received quarterly or monthly. And so you have to make sure this is not money you're going to need in 6 months. And this should definitely not be your last dollar or your emergency savings. Okay. So you have to have a timeline where you can afford to give this money to the deal while the hotel's being renovated or while you are enjoying profits as an owner and prior to the time that you sell to the new owner. So that's a timeline. The money has multiple places it can come from, like we talked about. And last, you can always vet the deal with your financial professional or an attorney or someone else you trust who's in the space and who has done it before. I did due diligence on all of my opportunities before I turned over $1. And I think that you should do the same so you ensure that your money is going to the right places.
And who do you use to do your due diligence?
So I use my network, boo. Yes. My network, Davon is one of my people because I've invested in deals outside of her. But there's also a couple consultants out there. I'm not going to drop them because they do like to hear about the case before they take it. But you can contact me. I'll drop my information. I'm on Instagram at The Purpose of Money, and I do offer free consultations. If your deal makes sense and the consultant is accepting clients at that time, I'll send you their way. They may charge a fee to review the opportunity, but that fee could be worth it if they save you from losing thousands. So please do not get overwhelmed by the cost or the process, because that is a part of the growth and you want to make sure that you're investing in the right things. So definitely keep that in mind. But there are people out there, you know, Hip Hop Hotel Broker, I know he has looked at a lot of opportunities too, and he shares opportunities. So those are a couple of people that I like in the space that can definitely help.
As our last word, like, what do you say to people who think like this is above their means? This is something that is way too high of a goal to reach, that this opportunity is not for them?
No, I say stop thinking that, because once I put in my mind that I wanted to do it, I focused on it and I asked God to bring into my life the people who would help me accomplish the goal. And he answered very quickly, because I would say I learned about multifamily syndications in May of 2020. And by June, I met Davon and Jessica. And by October, I owned a hotel. So it doesn't always look the way you think it's going to look, because again, my mind was focused on apartments and God showed me hotels, but he left the window open that once I had a hotel, I still stayed around the people who introduced me to apartments. I still looked at the deals that they were putting on their email list. And a year later, when the time was right, I invested. So keep your mind open. Do not be so focused on the outcome that you miss the blessing, because it might be different from what you thought it would be. And definitely just keep expanding your network, because like I said, if I never interviewed them on my podcast and decided to build a genuine relationship, I would have never known the value of now 4 hotels that I have interest in and 1 apartment syndication with 354 units. So I'm so blessed.
That is a portfolio for days, girl. And I love it. I love it. It's all made possible by the fact that you have set all these things in motion.
Yes.
I love you, Nasima. I do. I love you.
It's always a good time. And let's be clear. Nasima and I, we met through a mutual friend, interviewed you for a magazine, and we've become friends. So I definitely agree with you. When you're genuine and real, then it will manifest into an awesome
I'm blessed
blessing.
to have you in my life, boo.
Yes.
All right, y'all. This has been an amazing episode. Thank you so much, Acquania, for sharing all your gems. I really appreciate you and look forward to having you back on as our life insurance expert.
I look forward to it. Thank you so much.